Hello everyone, and welcome to your Glassnode video report for week 12, 2024. Now, Bitcoin has pulled back from its new all-time high of about 73,000 down to about 64. Now, it's recovered a little bit and is currently hovering around 68,000, if I'm not mistaken, at the time of recording. And really, there's a lot of questions about, is the cycle top in? And really, this comes from, have we run too far, too fast? It has been a tremendous start to the year, being up 175%. And whilst corrections are very typical during, they're almost expected and very normal during uptrends, there is also a point where you will hit some kind of a cycle top. And what that actually is remains to be seen, especially in this new ETF world. What actually defines a cycle top, and have we potentially hit it in very, very short order? So what we're going to be looking at is the tremendous rally we've had. We're up 175% year to date, which really is quite extraordinary. And it has pulled back by about 12%. So what we're going to look at today is a bit of an overview of the market structure up until this point, particularly looking at the corrections that we've experienced since the FTX lows back in 2022. So really that's pegging the entire uptrend since that point as the bull market, so to speak. And we're going to use tools like MVRV and AVIV ratios to try and just understand why the market has essentially bumped its head and found a pause. And in many instances, this is a very, very typical point during all previous cycles where investor profitability gets to a certain level and people do start to take chips off the table. And we can see this playing out in long-term holder supply. We covered that last week, so I do recommend checking out last week's video as well, as that will give you a nice bit of background information before we get started with today. But really looking at how we can assess the realized profit taking, assess the long-term holder spending, and use investor profitability to really get a decent read on whereabouts we are. And importantly, converting those observations into actual pricing models so we can start to look at these things in advance and say, well, if price was to get to this level, then we would start to expect there to be some volatility, some profit taking, and looking at when these investor behavior patterns really kick in. So as always, please do give us a rate, a share, and a subscribe. It just helps this channel get to more people. And without further ado, let's get stuck straight into the analysis. Okay, so here we are in our week Onchain 12 dashboard, and we're looking at, is the top in for Bitcoin, right? Now, obviously, I'm going to preface this by saying nobody knows, and anyone that tells you that they do know is probably kidding themselves, because we just don't know how these things play out, which is why we bring it back and just say, well, let's have a look at the data and see what the market is telling us. What can we draw out of typical cycle behavior? And just to start this thing off, the reason why we look at things like investor profitability is that profit and loss is what drives investors, full stop. And there's two forms of profit and loss in an on-chain world: unrealized and realized profit and loss. And to think about this question, what level do people say, you know what, my portfolio is now green enough, I'm going to take some chips off the table? And then the realized component is, are they actually taking those profits? So we're going to look at these two things in tandem and essentially run through it from top to bottom. So I just want to start with this chart, which has been one of my favorites over the last 12 months, actually probably 18 months. And it's looking at the depth of corrections during an uptrend. So what we've done here is we've isolated and indexed the price down the bottom for each of the previous cycles, and we're basically picking it from the cycle low. Now, of course, picking the cycle low is easier said than done. Now, what we did do is we started building this chart relatively early on and just saying, well, look, FTX looks like the low, but it may not be. We will find out and we'll adjust the chart accordingly. Nevertheless, it did turn out that FTX was in fact the cycle bottom, and we've essentially been in an uptrend on a macro scale ever since. Now up the top here, we've in these area charts, these are looking at the depth of the corrections. So from whatever the cycle high is in each of these index price charts, so within the uptrend, pick whatever the high is and then measure how much we've pulled back from that point. Now, something that really stands out is that Bitcoin during bull markets, if we, and it depends how we consider a bull market. Personally, I look at the 2018 bottom all the way up to 2021 all-time high as being the market cycle. We never set a cycle low, even though we had the March 2020 event. Others will choose March 2020. The story is more or less the same. We do sometimes get 50 to 60% corrections during the early years, most certainly, but then 2019 into 2021 was certainly a very interesting period with some very, very deep corrections. Now, if we go back to 2017, which by my eye, this market structure is a little bit closer to 2016 and 17 because it's largely a spot-driven market. The ETFs have really shown their hand to be an enormous spot supply sink. And back in 2017, we just simply didn't have the derivatives infrastructure. So in many ways, there's a parallel there between our 2016-17 and where we are at the moment. And we can actually visualize this, the pattern of corrections, the depth of corrections. It's different this cycle in that we've barely even had a 20% drawdown. So these lines here are just our classic Fibonacci levels to give you a bit of a visual read on where we are. We have barely had a 20% correction, certainly on a closing basis, since the FTX lows. So it's really showing that the market structure in this cycle is substantially, we're seeing a lot more buy side. We're just not seeing the kind of depth of corrections. Now, with that said, after 175% rally and after all the excitement and potentially with some sell the news coming into the halving event, which is in April, these are the kind of events where investors are likely to take some chips off the table. They know that the halving is one of these events, but again, the ETF was kind of an initial sell the news, but quite clearly didn't pan out that way over the medium term. So really just looking at market structure here, and we can really see that the corrections have been much, much shallower, which tells us that there has been this two-sided effect. Fewer people actually distributing coins, coupled with increased buy side pressure. So there's been this kind of both sides of the equation that's helped the price moving forward, in that demand has ticked higher, but we've also had a relatively low amount of spending. And of course, if you watched last week's video, that is up until we break the previous all-time high. And that's where things start to get pretty interesting. Now, this chart here is looking at the net unrealized profit and loss, commonly known as NUPL. This is one of our most popular metrics. And we've got three different variants shown here up in the top. We've got our short-term holders in red. We've got the aggregate market in yellow, or this kind of darker yellow color. And then we have in blue the long-term holders. Now, just to refer back, this is a derivative of the MVRV ratio, which is one of the most popular and well-known metrics in on-chain analysis. It is essentially showing us how much unrealized profit or loss are these different cohorts currently holding. Now, down the bottom, you'll see that the price chart has been colored. Now, what we're doing here is when all three, let's just start from the bottom, when all three cohorts are underwater, meaning that the price is trading below their average cost basis, this will flag blue. It's essentially looking for periods of capitulation when pretty much everybody who is even remotely speculative or thinking about selling, if we think about this from an investor psychology standpoint, these levels of unrealized loss, the red in people's portfolio, is usually enough to shake out all but the strongest of hands. And typically that is approaching a point of seller exhaustion, which we highlight here in blue. Now on the flip side, in an uptrend, we can see that we have this orange color and then a red. And the orange color is really highlighting when at least one of these NUPL variants is above +1 standard deviation from its long-term mean. In other words, the amount of unrealized profit held by any one of those cohorts, short-term holders, the aggregate market, and long-term holders, if any one of those is +1 standard deviation above their long-term mean, that is typically where we start to see the sell-side pressure start to kick in, because people have got enough green in their portfolio that they're feeling like taking some off the table. Now, what I also want to just highlight, again, let's use 2017 as our analog. We have typically seen this as we break the previous cycle all-time high, about 1400 back here in I think it was the border of 26, no, it was in 2017, where we broke through and we get more than two of those cohorts is in the red, getting into the very, very peak of the market. If we look back here in 2021, much the same. As we break the previous all-time high, the unrealized profit of at least one cohort goes above 1 SD. And when we get into the cycle peak, at least two of those, sometimes all three, are in a statistically meaningful degree of profit. Now, just to zoom in here, you can actually see that we have tagged at least one of those cohorts has moved into a statistically meaningful degree of profit. We haven't yet hit all, like 2 or 3 of those cohorts, but certainly we've hit one of them. So it's telling us, as we break the previous all-time high, the amount of unrealized profit is getting to the point where we can start paying attention. And I will just frame this up. If you've watched these videos for a while, you know that I described everything up until the all-time high, but above the true market mean price, which we'll touch on shortly. Everything in there I classify as the enthusiastic bull. People believe the market is now no longer in a bear. They believe that, hey, we actually might get to all-time highs again. Sentiment picks up, profit comes back into the system, demand starts to pick up. All of these things are very typical of a Bitcoin market cycle. And as we break through the all-time high, we typically transition from an enthusiastic bull, which is almost a bit of a breaking of the disbelief phase, to what I call the euphoric bull. And this, as you can see, can go on for a year or at the very least several months, where things can really get quite crazy if we look at things from previous cycles. And this is really what we're trying to frame up here with this data. Okay, so given that the NUPL is essentially a derivative of the MVRV, let's go back to basics and look at the MVRV ratio. Again, this is the unrealized profit or loss modeled out into an oscillator. So we're basically looking at what is the deviation between price and the realized price, which is the average cost basis for every coin in the supply. Keep that in mind, because we're going to touch on the AVIV ratio, which is a slightly different interpretation, but the MVRV captures the average cost basis of every coin, whether they're Satoshis, whether they're lost, whether they're the guy who bought yesterday, everything is included in the MVRV ratio. Now, what I've color-coded this by as well is looking at different standard deviations. It will flag red when we're above one standard deviation. So that's looking at when the amount of profit in the system is significantly higher than its long-term mean, right? We're starting to get into euphoric phases. And we can once again identify these market cycles. Prior to breaking the all-time high, we're typically below one standard deviation. When we get above it, we can get some distance above it. So this is what I'm talking about with the euphoric phase. Things can really blow out the top side. Now, of course, we could put different standard deviations here. You could put 2 or 3 or whatever models certainly suit your analysis or trading strategy. But in this instance, we're just doing very, very simple +1 or +half, -1, things like that, just to demonstrate how these cycles tend to move around. And as you can see, we are poking our head up into the enthusiastic phase. So you could reasonably consider that we bump our head here when we broke the previous all-time high. And previously, as we were trying to break the all-time high in 2016 and 17, there were several fairly deep corrections. You can actually see how much MVRV pulled back during those periods of time. Some of these were 25, 30, sometimes even 40% corrections. So it just gives people a bit of a framework that we are moving into a regime that is certainly, historically speaking, does see more upside, but it also has much, much deeper corrections. And in many ways, this is what investors are looking for, is trying to identify these relatively elevated periods of risk when you've got, just too much capital coming in at one time. And sometimes you just oversaturate demand for that period of time. Corrections, consolidations, and essentially pullbacks are typically what happens around that time. So we can start to assume that we're getting into the territory where a correction would actually make sense, looking at from the unrealized profit or loss perspective. Now, what we can do is, because MVRV is literally a derivative of the realized price, we can take those statistical bands, +1 standard deviation, +half a standard deviation, and actually convert them across into pricing bands. So in other words, when we were sitting down here at these lower prices, we could say, well, at what level would the market need to rally to when unrealized profit or loss gets too high, right? When there's just a statistically meaningful amount of profit. And in this instance, you can use these pricing bands to see where those price levels would actually be hit. In other words, what price does the market need to go to for MVRV to go above one standard deviation? Now, if we look at it from that perspective, the upper band, which is +1 standard deviation, is currently at about 71,000. So we've essentially intersected that and are now finding ourselves in a bit of a correction or a consolidation. So again, many of these things start to make sense. We can see 29, we actually hit that level, and that was essentially the top for about a year, where it consolidated from that point onwards. In 2020, we also hit our head right before we broke through the all-time high. And as we got too far above this band, we actually corrected back down to it. Now, we did spend a good portion of the first quarter of 2021, in fact, the first half, of trading above this level. So again, this is not necessarily a ceiling model. It's a level that's looking for when is there enough profit in the system that, historically speaking, people start to take chips off the table, at the very least from a statistical standpoint. You can see that the previous all-time high is actually where we also found resistance at this level. And the reason why is that investors are in enough profit to take chips off the table. That sell side pressure is what overwhelms the demand and essentially what puts the top in. It's the hodlers taking profits. into a regime where there's just not enough demand coming in to soak that up, that creates either cycle tops or creates consolidations and corrections in the shorter term. Now, this model here is the AV/IV ratio. Now, this is a product of the coin time economics work that we did with ARK Invest. And in many ways, I use this personally. I've been using this metric considerably more than the MVRV. And the reason for it is the blue curve here, it's kind of a derivative of the realized price, but rather than looking at every coin, we essentially say that we don't really want to know about Satoshi. We don't want to know about lost coins or very early miners. Coins that essentially are not economically mobile and actively participating in market structure. So it's really shrinking it down to the active supply, coins that are really likely and mobile to move during the market cycle. So it's using coin days and coin time economic principles to essentially isolate where the real middle of the market is. And for those who may have missed the coin time economics piece, I definitely recommend you check it out. But this particular pricing model, which we call the true market mean, has a long-term mean and median of approximately 1. So it is pretty much dead center in terms of the distribution of values around the price. And it also have seen where 50% of trading days is above and 50% of trading days is below. So again, giving some, it comes from first principles, but we actually found it to sit almost exactly in the middle of the market. Now, what that means is that the AV/IV ratio, which is essentially the deviation between price and the true market mean, is a very nice oscillator to look for mean reversion, because if it is in fact the middle, that would mean that the price wants to go back to it once it's spent a period of time away, it wants to come back and revisit that level. Now, I've got some statistical bands here as well, and what I really want to highlight is just different periods of market structure. So in the green is the all-time average for this particular model. And you can see that its current value is about 1.16. So again, the mean is very, very close to that neutral break-even cost basis level, which is what the true market mean price was constructed and designed to be. When we trade below that level, it's obviously during deeper bear markets, and below the -1 standard deviation is essentially the deepest phase of the bear. It aligns with our NUPL chart that we looked at before. Now, the enthusiastic bull that I mentioned, when we break above the true market mean, and we tend to oscillate around, typically below 1 standard deviation of the red, but around the 0.5 standard deviation level. This is what I call the enthusiastic bull. That period of time where we're above the true market mean, but we haven't yet broken through to new all-time highs. You can see that we spent since about October 2023, all the way through to our all-time high break in February, we spent in that zone. Now, once we get above half a standard deviation, notice that here's that volatility that starts to come in. We get very large rallies, very deep corrections, very large rallies, very deep corrections, and the full peaks tend to explode out the top and get to much, much higher standard deviations from that long-term mean. Now, given that we're at this point here, we have broken up into the euphoric phase, right? Above the orange zone, but not quite yet above the red zone. So in theory, and again, we don't know if this cycle is going to be the same. We're just looking at what previous cycles have done. And more importantly, what investors have done. What is their behavior pattern? And we haven't yet hit a profit or loss level that really signifies it would be the cyclical macro top. Now, it is really important to remember that if we actually do get a much deeper correction here, that is telling you something about demand. Even though we didn't get to the same level of profit taking and the same level of investor behavior pattern where they start to take lots and lots of chips off the table, the market wasn't able to absorb it. So a deeper correction here, whilst it's expected, we also need to just keep that in the back of our mind that if we do get a much deeper correction and perhaps the ETFs start to really slow down, that would be a sign that maybe things are a bit overheated and have in fact gone too far too fast, and we may be in for a deeper, longer, more extended correction. If, on the other hand, we continue to rally, it would very much be within typical market behavior. So in many ways, it gives us a bit of a framework to think about the market cycles, what different, let's call it oscillations or resonant frequencies that the market goes through. You can see that the euphoric phase has a very, very different character to what we see during the enthusiastic bull or even the bear and the recovery phase. You can really start to visualize and see how the market structure shifts and changes along these different lines and cycles. And again, just using some very simple statistics to try and model out different phases. Now, touching on what we covered last week, which is long-term holder spending. Now, this is very, very typical. You can see that previous all-time high breaks always commence a large-scale long-term holder sell side. This is in the orange, long-term holder sell side pressure. It's essentially their supply declining. Now, there's always coins that are migrating and maturing into long-term holder status. So when this metric is declining, it means that the amount of spending is not only offsetting the new coins coming in, it's more than that. So we're actually seeing a net decline in overall long-term holder spending. Now, down the bottom in the blue, this is what we call our binary spending indicator. Now, when we talk about binary spending, we're simply looking at, did long-term holder supply go up or down? And then what we do is we model that over a 7-day period. And when we have more than 7 days consecutively, where there's essentially a week of consistent long-term holder supply decline, it will flag down here and hit the green line. And we can see that we've actually hit that point. So for 7 days straight, long-term holder supply has declined. Now, we could obviously adapt this to look at, magnitudes and has it declined by a certain number of coins or put some statistics in there. But this is just to demonstrate an idea, which is that we do have a fairly substantial amount of long-term holder spending, and that is very, very similar to all previous all-time high breaks. So in many ways, this is the sell side pressure that creates these corrections. It creates these local peaks and eventually global peaks as well. Now, the last chart that I want to highlight, and again, if you spend any time on this channel, you'll know that I spend a lot of time focusing on the realized cap because it really is the backbone of so much of this analysis. And what we've got here is the realized cap in orange, but down the bottom is the realized profit. Now, just to give you a bit of a framework here, when a coin is acquired at a lower price and spent at a higher price, somebody else has to come in with more capital than the original purchase to buy that coin. So that represents a capital inflow. So the seller, the person who bought down at, say, $10,000, is realizing a profit, which is what this green chart is showing. And somebody else is coming in with that extra capital, injecting new capital into Bitcoin. The realized cap has been on an absolute tear, pushing up to a new all-time high of about $530 billion. So we have got an all-time high in capital invested, saved, stored within Bitcoin in the on-chain sense. So these are people who have acquired their coins, sold them to somebody else, and that new buyer has essentially revalued the coins to a higher level. Now, that's why we can use realized profit, which is currently up at very high levels, about $3.5 billion per day. It has surpassed the peak that we saw on this first correction here in 2021, which got to $2.3 billion per day. So that means that all the coins that are moving, most of them out of that long-term holder supply, are being revalued from a lower cost basis to a higher one, and the delta between the original purchase price and now is about $3.5 billion every single day. If you take all of the net realized profit, and that is why we can use realized profit and loss to actually model out capital inflows. Now, in a bull market, typically realized profits dominate naturally because price is moving higher, people are revaluing coins from low to high. Atypical behavior is that realized profit will dominate. But of course, there is a point in time when realized losses will start to kick in. And that is another metric we can look at because realized losses will pick up during corrections. It will also pick up as the bear market kicks into gear. When lots of people buy the top and they panic sell, you'll get an exponential increase in realized loss, going from not very much at the top to something more meaningful as the market trades lower. So just giving a bit of a framework, the realized cap is on a tear up to a new all-time high, and the market is currently locking about $3.5 billion of realized profit per day. Of course, there's other coins moving around the system. There's going to be futures markets and ETFs and all these different components. But generally speaking, we're looking at a period of net capital inflow, but this is, of course, balanced by the fact that this is sell-side pressure. These realized profits are the sell-side pressure that ultimately puts tops in at some point in time, whether temporarily or on a macro scale. But we can certainly use this to model capital inflows and just understand the amount of money that is now moving into the system. So thanks for tuning in for that session, folks. Hopefully you found that one useful. Really, when I look at the overall market structure and these different phases, whilst we don't know whether the top is in, we shouldn't be surprised that the market hits some kind of a correction here. It does make sense because we've got enough green in everyone's portfolio that people, historically speaking, have started to take profits. We can then see that in the long-term holder supply, which is in fact taking profits at a fairly substantial rate. Over 7 days, we've seen long-term holder supply declining. and realized profits have hit a new all-time high, 3.5 billion per day. So that really means that we need $3.5 billion worth of inflows into the asset to acquire those new coins. Now, these are fairly substantial numbers, but we're also talking about a post-ETF world. So these numbers are, we're talking about hundreds of millions to billions of dollars at the moment. But at the same time, these corrections, it makes sense for us to bump our head at this point. And we're also moving into, as you can see in the AVIV ratio down the bottom, a more volatile period. Historically speaking, the market can go up quite sharply, but then also correct almost as sharply as we saw in that correction chart, but also in our MVRV and AVIV ratio. So just something to keep in mind, and using that to kind of frame up where we are in the cycle, when we can start to expect resistance to kick in, and really using on-chain data to supplement all the other methods that we use in markets. So hopefully you found that useful. I'll catch you in the next one. Cheers.